Today, I wanted to talk about our high accuracy option trading program. Um, this is something we've used for many decades, and we use it to trade both call and put options. And um, just to give you a little background, right now we have mostly bullish positions in stocks because the equity markets are on a buy signal and they're in a price uptrend. However, what I'm going to show you today works just as well in bear markets when we take short positions. And during the 2001 and the 2008 bear markets, we were short almost all markets and we did very well. So the strategy you're going to learn today, the high accuracy, applies for both bullish and bearish positions. Today we'll be talking about bullish positions. So we're going to look at the high accuracy option trading strategy that we've used for many years. And I have a couple trades that you can take a look at for trading tomorrow. And then I'd be glad to take questions and answers session at the end of the presentation. So just to give you a little bit of background about the Hughes optioneering team, the high accuracy option trading strategy that we're going to look at today um, contributed to over $7.2 million in actual profits over the past 8 years in all types of market conditions, and it continues to perform well. And I'm going to show you some brokerage accounts. I took a snapshot of our option portfolios, and our brokerage accounts show that we have $1.7 million in open trade profits using this strategy that we're going to look at. And as Cam mentioned, the Hughes optioneering team, we have over 60 years of combined trading experience, and we started teaching option strategies to other traders 21 years ago. I only started out with a $4,600 trading account. That's all I could muster at the time. But in my first 2 years of trading, I had over $460,000 in profits, which is more than I made the previous 6 years as an airline pilot. So these are copies of my tax returns those first 2 years showing the $460,000 in option trading. So my trading became kind of a second income for me in the airline industry. It was very cyclical with layoffs, and whenever we went into recession, there was pilot layoffs and so forth. So I use this as a second source of income, and I've been trading ever since. And as Cam mentioned, we've won 12 World Trading Championship trophies, 7 first place trophies, 4 second place, and a third place. And I've won more of the, I've had more wins of that contest. I've had 7 wins, which is more than any other trader has been able to do so far in the 32-year history of the World Trading Championship. And in the contest, you use real money and real trades and real accounts. So the results are audited before they're posted on the sponsor's website. So it's all real-time trading. Last year I took second place and I had a 339% real-time return utilizing the optioneering trading strategies. So I'm not showing you these profit results to brag. I just want you to have confidence in what I'm going to show you today actually works in real-time trading. Okay, there's 2 parts to high accuracy option trading, and part 1 is we want to select a stock that we want to purchase a call option on, and I'll show you the 3 steps we use to select stocks or ETFs that have the best profit potential. And the first step is we want to look at the price trend of a stock, and we use the 50 and 100-day EMA systems, and I'll show you how we do that. Then we want to select a low risk entry point using the Keltner channels. And then the third step is we use what I call the 1% rule to select the option strike price that will have a high probability of success. And I'll show you how we um, use that 1% rule. It's a very simple rule of thumb, but whenever you're decide you're going to, let's say you're going to buy a option on Apple, you have literally thousands and thousands of strike prices to choose from. So I'm going to show you a simple rule of thumb to select a strike price that has a high probability of success. So part one, we're looking to find the best opportunities. We're looking at different stocks and ETFs that we want to trade. And then part two is we have trade management rules. Once we initiate a trade, then we have 3 trade management rules, very simple rules that help us manage the trade. And of course, that's a very big part of the program. So let's start off uh, by looking at the general risk involved with trading options. And options are leveraged and they provide more profit potential compared to stock investing. But of course, with that leverage, your risk also increases. So what I did is I took a snapshot of an option chain for Home Depot stock. And at the time, Home Depot was trading at 77, and I took a snapshot of the August options, and they at the time they had 67 days to expiration, so they had a little more than 2 months out before expiration. So if we were going to buy the at the money call for Home Depot when it was trading at 77.73, we would have purchased the 77.5 strike call, which was trading 320 bid, 330 ask. So let's assume that we bought that at the money call option, and we'll take a look at the risk profile for purchasing that option. And here at Hughes Optioneering, we've developed a series of 6 different option calculators for our various strategies. And what these calculators do is before you take the trade, you can input the data for the option, and the calculators will calculate the profit potential for that option, um, assuming various price changes in the underlying stock. And in this example, we went from a 10% increase in the price of the stock at option expiration to a 20% decrease. So let's assume we bought the Home Depot 77.5 strike call at 325, and at the time Home Depot was trading at 77.73. So we can see that if the stock was flat in this column right here, if the stock was flat and at option expiration was trading at 77.73, we would incur a 92% loss on that option. And if the stock was down at all, we'd incur 100% loss. So um, a lot of times when you buy an option, the expected move does not occur, and what you're up against is 100% loss of your capital that you paid to buy that option premium. So the goal of the high accuracy option trading program is not not to have one of these losses down here where you lose 100% or 92% of your money, because it doesn't take very many of those type of trades and you're going to be wiped out. So the whole goal here is to lessen this risk that we have with option trading, and still at the same time still realize a good return. So options, when you buy an option, you can easily lose 100% on that, and our goal is to avoid those big losses. And here's a snapshot of the VIX Index, the fear index. And these vertical lines here, the red and black vertical lines, represent the daily price movement of the VIX Index. And every one of these spike up represents a market sell-off. So every one of these spikes is market sell-off. So when you're trying to time a call option purchase, you can see where you could easily be wrong on your timing with all these sell-offs we had in the market over the last couple of years. And of course, that could result in 100% loss. So um, what we're trying to do is avoid those big losses, and we want to time our entry so that we can profit even though we've had all these sell-offs in the market over the last couple of years, and we'll show you how we do that. Okay, let's look at the first step in our trade selection process, and that is we want to determine the price trend of a stock. And the the goal of using a trend following system is to quantitatively measure the buying and the selling pressure of a stock. And what we try to do is we just try to follow the trend of the stock. If the stock's in an uptrend, we try to we'll buy a call option and try to participate in that up move in the stock. So we'd rather trade with the trend instead of trying to predict where the trend's going to go. So the idea behind using a trend following system is that you can quantitatively measure the buying and selling pressure and use a system to make the decisions instead of relying on emotional decision making, which can really get you into trouble. So this particular system I'm going to show you, we've been using that for 30 years, and it worked well in the 2002 and 2008 bear markets when we had short positions. So what we use to determine the trend is a simple moving average crossover, and we look at the 50-day exponential moving average in relation to the 100-day exponential moving average. And these can easily be downloaded on a number of different sites. So what we want to do is take a look at the relationship between those two averages, and if the 50-day EMA is above the 100-day EMA, then that stock or ETF is on a buy signal. And if the 50-day EMA is below the 100-day EMA, then that stock is on a sell signal. So if a stock is on a buy signal, then we want to buy call options. And if a stock is on a sell signal, then we want to buy put options. And the trend following works in both bull and bear markets. So let's go through and look at an actual option trade I took and the steps that I used to initiate this trade. This was for Cigna, the insurance company. And what I'm displaying now is the daily price movement of Cigna along with the 50-day and 100-day exponential moving averages. So these vertical black and red lines here, these represent the daily price movement of the stock. And this blue line right here is the 50-day exponential moving average, and the red line exponential moving average. So we can see back in September, this blue line, the 50-day EMA, crossed above the 100-day EMA. So when this happened, then Cigna stock went on a buy signal. So the blue line, the 50-day, crossed above the 100-day, and Cigna was on a buy signal. And as long as this 50-day EMA is above the 100-day EMA, then the stock is still on a buy signal. Okay, and the second step in selecting the stock is we want to use a low-risk entry point using the Keltner channels to select our entry point. The Keltner channels are very useful tools. They can help you time your trade entry and exit points. They also provide what I call high probability buy and sell signals, and I also use those to help select option strike prices. And then another use is it allows you to select stocks with repetitive and predictive price patterns, and I'll show you examples of that. The Keltner channels have they have three channels. This top blue line right here is the upper Keltner channel. The dotted line in the middle here is the middle Keltner channel, and then we have the lower Keltner channel, this blue line here. And this chart has the daily price movement of Home Depot stock along with the Keltner channel. So again, there's three channels: the upper channel, the middle channel, which is the dotted blue line, and then the lower channel. And the Keltner channels act as an oversold, overbought indicator. They're similar to the Bollinger Bands. They perform a similar function. I just prefer the Keltner channels. For my purposes, they're just a little more accurate, and I've used these for many years, and it can really be a big help when you're trying to time your entry. So the idea is when the stock price, which is this, the red and black lines here, when the stock price is near the upper channel, that means the stock is getting overbought. And when the price of the stock is trading near the lower channel, then the stock is getting oversold. So what we want to do is we want to find a stock that's on a 50 and 100-day EMA system buy signal, but has pulled back and has become oversold. And that's when we want to enter the trade. So we want to look at a stock that's in an uptrend, but it's pulled back, allowing for a low risk entry point. So the idea is we don't want to buy when the stock is overbought and it's trading near this upper channel. We want to wait till it retraces back towards the middle channel or the lower channel before we enter our trade. So you can see in this example with Home Depot stock, the stock got overbought here, and then it sold off, got oversold here, and then rallied, overbought, sold off, became oversold, rallied. So you can see that pattern of when the stock gets overbought, it normally retraces, and when it gets oversold, it normally rallies. So we like to just use this as a timing tool to help us enter our trades. So here's a daily price movement of Cigna, and I had been watching Cigna for a while, and you can see that it was in a very strong uptrend. So the question is, you want to participate in that, but you don't want to buy a call option when the stock is overbought, because the odds are it's going to sell off. So you want to wait till the stock is oversold, but still in a price uptrend according to our EMA average system. So right here, we can see that Cigna retraced towards that lower Keltner channel. So this was on June 3rd, right in here. I went ahead and bought, this is my brokerage confirmation here, I went ahead and bought the Cigna July 50 strike call right here when it was oversold, and we can see that that provided a low risk entry because the stock proceeded to trade up from this entry price, and Cigna now is trading in the 130 range. So we can see that the Keltner channels it became oversold here. I bought the call option, and then the stock went up from there, so I got a low risk entry on that. Here's another example. This is for Caterpillar, and we can see again Caterpillar was in a strong uptrend, and I waited until it retraced towards the lower Keltner channel, and then I bought the August 70 strike call right in here, and then Caterpillar started to advance. So again, I got another low risk entry by using these Keltner channels. And Caterpillar has since gone down in price, and it's gone into a downtrend. But I'm going to show you one of our money management rules is whenever we buy an option and we get a profit in it, then we create a spread that helps protect our profit. So even though Caterpillar subsequently went into a downtrend, we still had a profitable trade because we initiated the 30% rule for protecting profits, and we initiated an option spread, and I'll show you how we do that. Here's another example. This is for Wells Fargo. Again, it was in a strong uptrend, and I wanted to participate in that uptrend, so I waited till it retraced right in here, and then on April 9th, I bought the May 35 strike call right in here, and then Wells Fargo resumed its uptrend, so it allowed me to get a low risk entry. Here's one more example. This is for SSO. That's the double leveraged S&P 500 index, and we can see another strong price uptrend. Question is, where do you jump in if you want to participate in that uptrend? So I waited till the SSO retraced towards this lower Keltner channel that was on April 11th, and then I went ahead and bought the January 65 strike call right in here. And again, SSO, after it had this sell-off, it resumed its rally, and I got another low risk entry. So the whole idea is with using the Keltner channels is we want to buy a call option when the stock is oversold, with the idea that when it's oversold, it's normally going to rally after that in the context of the stock being on a buy signal, and then that allows for low risk entries. And those low risk entries, of course, they help prevent you from getting stopped out of your position. And with options, if your timing's wrong, you can get into trouble really quick. So the whole idea is you want to get a low risk entry when the stock's oversold, and then it resumes the rally. So another use of the Keltner channels is to take the easy road to profits and avoid the hard road. And by what I mean by that is if you pull up these Keltner channels on stocks and you start looking at these Keltner channels, you're going to start seeing stocks like Cigna, where you can see the price movement is very repetitive and predictive. So when Cigna retraces towards the middle or lower Keltner channel, then it rallies again, retraces, rallies, retraces, rallies. So very predictive price pattern. These are the kind of stocks we want to trade. And this price chart below here is for Tesla. And we can see there's no clear trend with Tesla. There's no repetitive price pattern. It's a very hard stock to trade, and the idea is we want to take the easy road. We just totally avoid stocks like this that have no clear trend, no predictive or repetitive price patterns, and just focus on stocks like Cigna that do have repetitive price patterns. So there's no point in even trading stocks like Tesla. Let's look at some more examples. This is for L brands. You can see very repetitive price pattern versus Twitter, which is up and down and all over the place. And Twitter is just too hard to trade. I'd rather stick to stocks with repetitive price patterns. Here's another example. This is ABC. We've owned this stock for a long time. You can see very clear predictive uptrend, and this bottom price chart here, that's the gold spider, the gold ETF, and you can see very difficult to trade. You know, whether you pick a long or a short position in here, you're going to get chopped up. So there's no point in even trading stocks like this. So it's a good idea to pull up these Keltner channels. They're available on many different websites, and I just use the standard default parameters for the Keltner channels. It's the 20, 2.0, and 10. and I just use the standard defaults for to display the Keltner channels, and you can see it can really be a useful tool when we're trying to find stocks that are easy to trade versus stocks that are very hard to trade. Here's another example, Sherwin-Williams. We've owned this for a long time versus Priceline. And here's one more, Cardinal Health versus Groupon. So again, we like to just focus on these stocks that are very predictable. Here's a couple snapshots I took last night. This is for Fortinet. We've owned this for a while. That's a software security company, and it's been in a strong uptrend, and we can see that it's retraced near the middle Keltner channel. So we're looking to add to our position in this one on this retracement. So that's one to keep in mind. And this is Disney, and we're looking to add to our position in Disney. We've owned this for a long time too, and you can see it's trading near the this middle Keltner channel, the dotted line right here. So they're trading ideas for the future. And the third step in our stock selection process is selecting the option strike price that's going to have a high probability of success. And this is a really important step in the process. And once you stock that you want to buy a call option are, you're going to have hundreds, sometimes thousands of strike prices to choose from. So selecting the strike price becomes just as important as the trade selection itself. So I've developed, over the years, I developed a very simple rule of thumb that can help us select the strike price. So option premiums, of course, they consist of time value and intrinsic value, and options lose all of their time value at option expiration. So when you buy an option, you're buying a decaying asset, and each day the time value portion of that option is going to decay. And when you get to option expiration, the time value is zero. So due to these time decay characteristics of options, when we buy an option, we want to minimize that time value because that's going to go to zero, and we want to maximize the intrinsic value so we're not losing a lot of value in the option premium each day as you get closer to option expiration. So I use a simple rule of thumb, and we want to limit that time value to less than 1% of the stock price per month. And if we do that, and limit the time value to 1% of the stock price per month, that'll allow us to minimize the time value and maximize the intrinsic value. So that's always the goal when you're buying these options that are a wasting asset. You want to minimize the time value because that's going to go to zero, and you want to maximize the intrinsic value. So for an example, if you were purchasing a 1-month option and the stock's trading at 100, then you want to limit the time value portion of that premium, option premium, to 1 point or less. So 1% of the stock price per month would be 1 point, and over a 1-month period that would be 1%. So you're limiting the time value to 1% of the stock price over a 1-month period. So if you bought a 2-month option and it was trading, the stock was trading at 100, you want to limit the time value to 2 points, which over a 2-month period would be 1% of the stock price per month. So I'll show you actual examples of how we use this rule of thumb. So now here's the big benefit to this rule. If you limit the time value to 1% of the stock price, then the stock only has to go up 1% in order for the trade to break even and for you to start making money. So that's really important. So if you use this rule of thumb, the stock only has to go up 1% and you start making money on the option. So this is going to have a much higher probability of success than an option strike price that requires, let's say, a 6 to 10% increase in the price of the stock just to break even. So let's look at an out-of-the-money call purchase first. And I don't have any trades I can show you because we don't we don't buy out-of-the-money calls. We only buy in the money. So what I had to do is take a snapshot of an option chain to show you an out-of-the-money call, and this was for Priceline. And at the time, Priceline was trading at 1,162. So let's take a look at an example of buying an out-of-the-money call option. In this example, let's look at buying the 1270 strike call for Priceline. And if the stock is trading at 1162 and the strike price is higher, that would be considered an out-of-the-money strike. So the 1270 strike call at the time was trading 1150 by 1260. So the way you calculate the break-even price would be you would take the strike price, in this example 1270, you would add the premium of 1260, and you come up with 1282. So the stock would have to go from 1162 to 1282. That's a 120-point increase in order for this trade just to break even. So with these out-of-the-money calls, you're really stacking the odds against yourself when the stock has to make, in this example, the stock has to make a 10% move in order for you just to break even. So we don't want to trade these at-the-money or out-of-the-money calls because they're almost all, well, they are all time value, which decays to zero. So we want to avoid this. So this example of an out-of-the-money, the stock has to increase 10%, and in order for you to just break even. So let's look at our call option purchase calculator. And again, this assumes various price changes in Priceline stock at option expiration. In this example, from a 15% increase in the stock price to a 15% decrease in the stock price. And the calculator will also calculate the time value and the intrinsic value of an option. You can also do this manually. But in this example, the time value is 1260 and the intrinsic value is 0. So this out-of-the-money call has only time value. And again, the stock would have to increase 10% in order to break even. And if the stock is flat at 1162, you're going to lose 100% of your premium. Or if it's down at all, you're going to lose 100% of your premium. And even if the stock goes up 5%, you're still going to lose 100% of your premium. So this is kind of like a reality check when you're trading options, to look at this and say, hey, you know, if the stock goes up 5%, that's a pretty big move over the course of a month or 6 weeks. And if it doesn't make that 5% move, I lose 100%. So you don't want to do that. So now let's look at an example of an in-the-money call option purchase and compare the profit potential for an in-the-money versus an out-of-the-money. And what I'm displaying here was that Cigna example when Cigna stock became oversold, and I jumped in and bought the 50 strike call. And at the time, Cigna stock was trading at 66.71. So the 50 strike call is underneath the strike price, so this would be considered an in-the-money call. So let's look at the risk profile in this. So here's the call option purchase calculator. Cigna stock trading at 66.71. We bought the 50 strike call and we paid 17 points. So we can see that this is in the money, and the time value of this option is only 29 cents, and the intrinsic value is 1671. So we've achieved our goal of maximizing the intrinsic value, which is 1671, and minimizing the time value, which is just 29 cents. And this Cigna stock, in this example, it only has to increase 29 cents, and I break even on this trade and I start to make money. So I'd much rather have a scenario where the stock only has to increase 29 cents and I start making money versus that price line example where the stock had to go up $120 before we break even. Of course, the price line is much higher. So, but in this case, the stock only has to increase 29 cents or 0.4% to break even. So I met the 1% rule here because the stock only has to go up 0.4% in order for this trade to break even. So, and we can see that even though we're buying, this was in the money, this call option, we can see that if the stock goes up 10%, I'm still going to get a good return. If the stock goes up 20%, I'm going to get a 76% return. So I'm still going to realize a good return if the stock goes up, but if the stock is flat or goes down, I'm not going to lose as much. And we can see that if the stock is flat, I only lose 1.7%. So as it turned out, in this example, Cigna did close at 77.84 at option expiration. So I had an actual 63% return on this option. Okay, and again, with this example, Cigna stock only has to increase 29 cents or 0.4%. Then I break even and start making money. And I'd much rather have that scenario than buy an out-of-the-money call that required, in the price line example, a 10% move in the stock just to break even. Because a lot of times these stocks, you buy these call options and you think the stock's going up and it doesn't. And not only do you have to be right about the direction, but the stock has to make its move before option expiration. So with options, you have to time not only your entry, but the stock must make that expected move before option expiration. So a lot of times that's not going to happen. You don't want to lose 100% of your premium just because you had bad timing. It's much better to have an in-the-money call, and you're going to lose a lot less if you're wrong. So what I'm going to show you here is some real-time results for this high accuracy option trading program. This is in our brokerage accounts, and we have $1.7 million in open trade profits. There's 18 trades. We don't have any losing trades, and the average return for these two accounts is 223%. So these are snapshots from two different brokerage accounts. This first account has $1,356,000 in profits, and this snapshot of the portfolio shows the option in this column right here, the number of contracts that we purchased, the price that we paid for the premium, and then it has the last price. So in this column right here, it adds up the profit or loss, the dollar profit or loss, and in this column, it's the percent profit or loss. So if we add up this column here for this brokerage account, it had 1.3 million in open trade profits. And in account number 2, we had $400,000 in open trade profits. So you can see the strategy is still doing well. So let's look at the second part of our high accuracy option trading, and that's trade management. And this is an important part of our success, because once you put that trade on, you want to manage it. And we have 3 simple rules that we use when we manage our trades. And I just want to mention that this would be considered, these trades that we're taking would be considered intermediate trades. In other words, we don't have to watch the markets closely. I normally just look at my positions once a day, and there's no need to monitor the market. It's more of an intermediate term system, and the options we purchase vary between a month to 3 months usually, and we also mix it up with leaps options, and we'll buy some longer term options. So this is an intermediate term system, no need to follow the market closely, and um, we normally just look to see if our protective stop is going to be hit, or if we have a profit, then we use rule two if we have a profit. So this is the way we manage trades. So rule one is the 30% rule for walking away. That's a protective stop rule. And then rule two is if we have a 30% profit, then we're going to create an option spread and protect that profit. And then the third rule is we're going to roll over that option at expiration if the stock is still on a prime trade select buy signal and the trade is profitable. So we have three simple trade management rules. Let's take a look at examples of those. And rule number one is use the 30% rule for walking away, and that's a protective stop rule. And if a options price, if it drops 20% below our entry price, then we want to start looking to get out of that trade and exit before we have a 30% loss. So I'd rather have a 30% loss than a 100% loss. So it's a simple stop loss rule, and that can help prevent 100% loss. So let's look at an example. Here's a trade where I bought the J&J 80 strike call at 23.72, and what we would 72 is we would just kind of look at this each day, and if that premium we paid 23.72, if that starts to drop, and let's say it drops 20% to around 19 points, then we would start to look to exit this trade. For whatever reason it didn't work out, so we start to look to exit this trade if it drops 20%. In this example, if we paid 23.72, when it gets down to around 19, we would start to look to get out of this trade. And if it gets to 30%, we would definitely close out the position. In this example, if we paid 23.72, if that premium gets down to around 16.60, then we're out. And most of the time we exit before we have a 30% loss, but as a fail-safe, if it's 30%, then we're out. So I'd much rather have a 30% loss than a 100% loss. So that's why we use this protective stop rule. Okay, then the rule number two in the trade management is what we call the 30% rule for protecting profit. So if we have a 30% profit on an option, a call option, then we'll create what's called a market neutral option spread. And what that does, it provides downside protection and protects your profits in the event the underlying stock decreases in price. And this can help prevent a winning trade from turning into a losing trade. So as traders, we know one of the hardest things to get over is if you have a winning trade and it turns into a losing trade, that's hard to take. So you're always faced with a dilemma when you have a profit in an option. You're always faced with that dilemma. Well, do I close out the option and realize my profits in case the stock goes down? But if you close it out, then there may be further upside potential. So by buying a put option, you still get that upside profit potential if the stock continues to rise, but at the same time, the value of the put option will rise if the stock goes down. So you always want to protect those profits when you get them, and that can help prevent a losing trade from turning into, or that can help prevent a winning trade from turning into a losing trade. So we use this 30% rule, and we buy a put option on the same stock, and that helps protect our profit. So let's look at some examples of these market neutral spreads. This is a brokerage statement, and we can see this is for Cigna, and we bought the September 70 call, and we paid 188 for that. So this uh, option cost $188. So we used the Prime Trade Select to select this trade, the Keltner Channels to enter it, and we purchased the 70 strike call at 188. And then after we purchased that call, Cigna stock went up in price, and we had a profit in the option. So we used the 30% rule, and we went ahead and bought the Cigna September 77.5 strike put option, and that created a market neutral spread for our profitable call option purchase. So we legged into this spread. A couple weeks later, we had a profit on the call option, so we went ahead and bought the put option to protect those profits. So we paid $188 for the call, and then we paid $161 for the put. So of course, the 70 strike call option, that profits as Cigna stock moves up in price, and the 77.5 strike put, that profits if Cigna moves down in price. So we have what we call a market neutral trade here, because the call option profits if the stock goes up, and the put option profits if the stock goes down. And we have a calculator for these market neutral spreads, and of course we use this before we take the trade. But the market neutral calculator again will calculate the profit potential for the spread trade, assuming various price changes in Cigna stock. In this example, from a 20% increase in the price of the stock to 100% decrease in the price of the stock. Of course, we would not expect such a big loss, but I plugged that in there just so you can get an idea of how this strategy works. So let's take a look. Again, Cigna stock trading at 77.72. We bought the 70 strike call at 188. We had a profit in that call option. Several weeks later, we went ahead and bought the 77.5 strike put to protect those profits, and we paid 161 for that. So if the stock is flat at option expiration at 77.72, we'll realize a 120% return on this trade. And if the stock is up 10% at option expiration, we get a 342% return. If the stock was up 20%, we'd get a 564% return. So these are great returns if the stock is flat or if it goes up. But what if it goes down? So let's take a look at the what happens if the price of the stock goes down. Let's assume the price of the stock went down 20%. Then the value of that put option really goes up. So if the stock goes down 20%, the spread would have a 337% return. So we can see if it goes down 40%, we'd have a 781% return. So even if the price of the stock drops with these market neutral spreads, you can still make money. And if it drops a lot, you can make a lot of money with this spread, even if the stock drops a lot, 20, 40%. So this is a good way to protect your profits. You're always faced with that dilemma when you have a profitable trade. Do I take profits now? But if I take profits now, I'm going to miss in the further upside. But you can see with the market neutral spread, it doesn't cap your upside. So the more the stock goes up in value, the higher your return is going to be. And also at the same time, it guarantees that you'll have at least, in this example, 120% return. And if the stock really crashes, then you're going to have even a bigger return. So that solves that whole dilemma. When you have a profitable trade, what do you do? And in this case, you can hold the position in case the stock continues to increase and profit. And at the same time, if the stock starts to go down, you're still going to profit. So this is a good way to manage a profitable trade. And once you put this trade on, you can forget about it until option expiration. You don't have to worry about putting in a protective stop. You don't have to worry about bad earnings reports or big down moves in the stock. You just put this trade on and forget about it. So this is a snapshot of market neutral trades we had for Cigna, Costco, Johnson & Johnson, Starbucks, Wells Fargo, and Yahoo. And this lists the call and the put options in this column, the price that we paid, the last price, and then this column has the dollar profit and loss, and then the percent profit and loss. So this portfolio had an average return when we took the snapshot of 422%. And what I did is I went through this portfolio and I used the market neutral option calculator to analyze the profit potential for the whole portfolio. So I input each one of these, the Yahoo trade, the Wells Fargo, Starbucks, Johnson & Johnson, Costco, and Cigna. I input each one of these into the market neutral calculator, and then I got profit potential for the whole portfolio. And we can see that if the portfolio on average was flat, if the stock prices were flat, this portfolio would have a 711% return, and if the average stock went up 10%, we'd have a 711% return. If the average stock, we'd have a 1,319% return. And then again, if the average stock in this portfolio goes down, then we're also profitable. So you can see that no matter what happens with this portfolio, it's going to be profitable. Okay, so as you can imagine, this is a great way to invest. You know, as veteran traders with decades of experience, we've been burned many times by unexpected market declines. And if you have a highly leveraged option portfolio and there's an unexpected market decline, you could lose 100% of your investment in these option premiums. So sudden market decline could wipe out your portfolio if you just own the call option. Of course, by owning the put option, that can even sometimes guarantee that the portfolio or that trade will be profitable no matter what the underlying stock does. So this is a great way to trade options, and it's very easy to implement. And you know, the worst feeling as a trader is to be sitting on a profitable portfolio only to see that portfolio turn into a losing portfolio due to unanticipated market decline. And these kind of declines happen all the time. I showed you that chart of the price chart of the VIX Index, and you could see how many market declines we had over the last several years. There's been quite a few. So this is a great way to trade options. And we had call options on MasterCard stock, and a while back, MasterCard had a bad earnings report. So the value of the call options that we owned actually would have had 100% loss, but because we bought the put options and created that protection in the market neutral spread, we actually closed out those MasterCard market neutral spreads with a $41,000 profit and a return of 1,353%. So that was after a sharp decline in the stock. So these kind of sell-offs can and do happen. And in this example, if we had just owned the call option, we would have had 100% loss. But because we had the market neutral spread and there was a severe decline in the stock, that generates windfall profits when that put option kicks in and becomes profitable. And in this example, we had a 1,353% return. So these type of sell-offs do occur, and you want to have your call options protected with the put option in case there's an unexpected decline. You can still make money on the trade. So this is a very comfortable way to trade, and it turns option investing from one of the riskiest investments to one of the safest if you can implement these market neutral spreads when you have a profit in your call option. And here's a snapshot. This is actually in my retirement account, and I had market neutral spreads. And in this account, I had $199,000 open trade profit. I had Apple, Facebook, Home Depot, and the healthcare ETF in this portfolio. And you can see that with the first position is Apple put option. You can see I lost money on the put option, but on the call option, I had a $7,000 loss on the put option, but a $74,000 profit on the call. So I'll gladly take a loss on the put option if it's going to protect my position in case Apple stock goes down. So it's a trade-off. The put option is going to cost you, but that portfolio and trade protection is very valuable in case that stock sells off. And in the case of MasterCard, it did sell off, and we had a nice profit in that instead of a loss. So, and here's my other retirement account, and this portfolio has a $70,000 open trade profit. And the nice thing about these two portfolios is no matter what happens to these stocks, these portfolios will be profitable because of the market neutral spread. So here's one last thing I want to talk about, our trade management number three, and that is to roll over options. And when you roll over an option and you have profits in it, then that reduces the risk and the cost basis of your new position, and that allows you to compound your return. So let's just look quickly. On our rollover rule is if the stock is still on an EMA buy signal and the trade is profitable, then we'll roll over the option at expiration. So let's look at an example. These were trades I closed out. This was for Google and the healthcare ETF. So in this column shows my net profit after commissions for these options. So what I did is I rolled over these options, and with the first one, I rolled over the healthcare ETF, the XLV, and I closed out these trades right here. I got different fills on that. That's why there's 5 different prices here. I got different fills, but the net result of all that was I had a $31,000 profit on the 36 calls that I rolled over, and then I purchased the September calls at 1569. So the cost of the new calls was $56,500. I had a $31,000 $500 profit on the rollover. So now my new cost basis for the September 45 calls is only $25,000. So instead of risking $56,000, I'm only risking $25,000, and that reduces my risk and allows me to compound the returns. Here's the Google trade. I closed out the Google trade with a $7,670 profit, and then I bought the December 450 calls at 146. So the cost of the new option was $14,693. I had a $7,670 profit, so that reduces my new cost base $1,000. So again, that reduced my risk by 50% and allowed me to compound my return. So I have an advisory service, and we make recommendations for call option purchases, and then we have another portfolio for market neutral spreads. This is showing you the open trade profits for the option portfolio. You see option strategy we just discussed. We have $399,000 open trade profits and average return of 426%. And in the market neutral portfolio, you have $289,000 open trade profits, average return of 145%. So our advisory service is called the Wealth Creation Alliance, and if you click this link here, it'll give you information on buying the advisory service, and members get email alerts on specific instructions whenever we have a new trade recommendation, or if we're going to close out an existing trade. So we send out an email telling you exactly what to do, and then we maintain a portfolio in the member section of the current open trades, and then each day those prices are all updated so that you can track the real-time performance of every trade recommendation. When we close out a trade, that goes into the closed trade record. So we always have an accounting of all the trades that we recommend with the advisory service. And we also include the 6 option calculators that we developed. And you can use these before you take an option trade, and it'll reveal a lot about your risk versus reward before you take the trade. So that's all available with our option advisory service. So that concludes my presentation today, and I'll be glad to take any questions.
Okay, Chuck, can you hear me?
Yes, I can hear you.
Okay, while you were talking, I just jotted down a couple of the questions that came in. Let me just pull them up really quickly. One of the questions that came up in the presentation was a lot of the data initially dealt with 2013 data.
Right.
And the question was, why were we looking at 2013 data?
Well, that I was explaining actual trades that I took using the strategy. So the time frame really doesn't matter. We go back many years using this strategy. We're still using it today. It's just that I use that as a example, a demonstration of how the strategy works. And
yeah, and while you were doing that, I was actually up on your website, and you have some current data that's published. So it's I could see that it was good for demonstration purposes. John asks,
right.
Can you use? I'm sorry.
And I also had the.
John asks. Go ahead.
Yeah, I also displayed the current profit results too in there, which we currently have in real-time profits. I think it was $1.7 million in real-time profits. So that's current. And the examples I used may have gone back several years, but it doesn't really matter. I was just demonstrating how we use the strategy to purchase options and when we purchase the options and how we select the strike price. Yeah, it applies at any time period, really.
Okay. And John asks, can you use the 5100 EMA strategy in weekly options?
Yes, you can, and we do trade weekly options, and we do use the 50 and 100 day EMA to determine the price trend of the stock, and then we use the Keltner Channels to select a low-risk entry point. So yes, we do trade weekly options, and we do use the EMA system for trade selection.
Okay. Randy asks, what EMAs can be used for day traders for buy-sell signals? Hello?
That's a good question. um, you'd want, obviously you'd want to use shorter term EMA time frames when you're day trading. As I mentioned, our trading is intermediate term. We go out several months, so I use 30-minute bars or 1-hour bars to day trade. So we don't really do any short-term trading. So
Okay.
I used to at one point, but you obviously want to use a shorter-term EMA system for that.
Okay. And Brian asks, is there a list of reliable stocks to look at?
There is, if you I guess the best way to start out is on any given day, look at the new 52-week high list, look at those stocks on that new 52-week high list, and then go ahead and display the price chart of those stocks in the Keltner channels, and you'll find a lot of great stocks that are in very clear, predictable, repetitive price patterns on those stocks that are making a new 52-week high.
Okay. Brian asks, for your 1%, this was in one of your examples, for your 1% rule, so I understand, using DIS, would you buy the 108C?
Let's see. If let's see, where is Disney trading right now? I think it's trading around. Well, to answer the question, what you would do is, let's say you were going to buy the July a July Disney option. You would look at the strike prices, the in-the-money strike prices for the July Disney calls, and let's say Disney let's just say it was trading at 110. You would look probably at the 90 strike call or the 85 strike call, and then calculate the time value portion of that option, and you want to limit that to 1% of the Disney stock price. So if Disney was trading at 110, you'd want to limit the time value to $1.10, the time value portion of that option to $1.10. And if you do that, then Disney only has to go up 1.1 points, and that trade will break even and start to make money. So it's the time value portion of the option. You want to limit that to 1% of the stock price.
Okay. I'm going to combine a couple questions here that I think you addressed earlier, but do you set trade stops, and how do you decide to exit the trade assuming you don't get stopped out?
Okay, yeah, what we do is we initiate if we have a 30% profit in the trade, then we initiate a market neutral spread, and then we can just forget about that spread until option expiration. Then at option expiration, if it's still on a 50 and 100-day EMA system buy signal, and we have a profit in the trade, then we'll go ahead and roll it out another 1 or 2 or 3 months. So to answer the question, we manage the trade once we enter it, and if we have a profit, 30% profit, we're going to create a spread, and roll that over at expiration if it's profitable. And if we have a loss on the option, we're start to look to get out of it if we have a 20% loss. And we're usually out by the time we reach about a 25% loss, and many times long before that. So we only want to take a 20 or 25% loss. We want to cut short our losses. So if the trade goes against us, for whatever reason, we'll exit. We'll start looking at it when it has a 20% loss, and then we're out by the time it has a 30% loss. So if it's a losing trade, we use the protective stop. If it's a winning trade, then we create the market neutral spread strategy.
Okay. How do you determine the put strikes to make the spread?
The put strikes, normally we do those at the money. As a general rule, the put strike will be at the money, and then if the stock starts to drop, of course, then the put starts to profit. And as you could see from those examples I showed you, once we established those market neutral spreads, we were going to profit no matter what the stock does. But in general, with the put, we go at the money.
Okay. Pat asks, when you're picking stocks, is there any method to separate the smooth trending ones from choppy ones other than visually looking at the chart to see what it has done in the past?
No, there's no way to do that other than to look at the chart, just eyeball it, and it only takes a few seconds, and you can see right away if that's a stock you want to trade. But as I mentioned before, the best place to start would be to look at that new 52-week high list and start from there, and you'll get a lot of stocks that are in very, very smooth, predictable price patterns.
Okay. Ryan asks, what do you mean roll at expiration? Is that the week of expiration, the prior week? What are your rules for rolling?
We usually rule if we have a 2-month option, we'll normally start to roll it over a week to 2 weeks before expiration.
Okay. And how do you calculate the time value of the option, and which calculators are you using?
Yeah, the time. Well, we developed option calculators that I displayed in. Whenever you buy a call or a put option, it will display the time value and the intrinsic value, and those calculators are available to advisory members, to the Wealth Creation Alliance advisory members. And we have 6 different calculators, and the call option purchase and the put option purchase calculators will calculate the time value portion of the option.
Okay. And last question is from Brian. Option value is shown as a combination of intrinsic and extrinsic value. There was no mention of volatility. Can you elaborate on decisions relating to volatility?
No, I don't really take that into account because, well, actually, I do take that into account when we use that 1% rule, because the more volatile stocks, you'll have to go a little deeper in the money to use that 1% rule. So we do account for the volatility in that sense. So the more volatile the stock is, the deeper you'll have to go in the money to achieve that 1% rule. But other than that, we don't really look at the volatility, and we don't look at any of the Greek parameters for options. We simply want to buy a call option on a stock that's going up, and we use the protective stop if we're wrong, and we create a spread if we're right.
Okay. Well, Chuck, I really enjoyed this presentation. I thought it was quite informative. From my perspective, I really like to see how you use the 5100 EMAs and Keltner channels to identify opportunities. I thought the 1% rule was pretty straightforward, and I liked your focus on in the money options versus out the money or out of the money options. The 30% walkaway rule was straightforward to me, and I like the 30% rule for protecting profits as well. I also appreciate the special offer you put together, and I encourage everyone on this webinar to click on the link that Yana has provided and to take advantage of Chuck's offer. And Chuck, once again, thanks very much. I thought it was an excellent presentation.
Okay, thank you, Cam. And I enjoy doing these webinars. I actually learn a lot from the questions I get. And so it's actually a learning experience for me, because listeners will think of things that I never would have thought of until I had the webinar and got those questions, and then I do research on it. And that's how over the years, how I developed a lot of my techniques and strategies. So I enjoy doing the webinars, and I was glad to be here today.
Yeah, and and as one final thing, I mean, with the track record that you've had in trading competitions and the fact that you have the transparency to publish your your personal financial statements and your track record, I think that says a lot for what you're doing, as opposed to many people who talk a pretty good game, but when it comes time to show what they've done, they kind of disappear.
Yeah, yep. Yeah, I like to use all real-time examples so that you know that I'm not talking about something that was computer generated or hypothetical or optimized. The real trades are what they are, and I like to use real-time results to demonstrate the effectiveness of the various strategies.
Well, very good. Well, Chuck, I hope you have a nice Memorial Day weekend, and for all of our friends here in the U.S., I wish the same to you. And we've had a great webinar here, and I just hope everyone got something out of this, and we'll see you the next time. This is Cam White
Okay.
with Trading Club.
Okay, great. Thank you, Cam. Have a great evening, everybody.